As we approach the end of the year, I wanted to take a moment to reflect on the market, the economy, and how we're positioning portfolios in light of the recent election results and broader economic trends. The U.S. economy continues to surprise on the upside. Over the last 9 quarters, GDP growth estimates have beaten expectations in 8 of them, which really is a testament to the economy's underlying strength. This strength is largely driven by resilient corporate earnings and robust consumer spending, which makes sense given that consumer spending accounts for nearly 70% of our nation's GDP. Despite inflationary pressures earlier in the year, consumer confidence remains strong, held up by wage growth and a healthy labor market. Speaking of inflation, it has moderated significantly this year, helped by easing supply chain disruptions and the Federal Reserve's proactive stance. So far, the Federal Reserve has cut interest rates by 75 basis points in 2024, which really provides a favorable environment for businesses and consumers. Post-election, we've seen a rally in the stock market as investors anticipate pro-market and pro-growth policies from the incoming administration. However, it is really important to note that some of these proposed policies, such as tariffs, mass deportations, and tax cuts, all carry inflationary risks. Tariffs are going to increase the cost of imported goods, while mass deportations could tighten the labor supply, driving wages higher. Lower taxes, while yes, it will boost disposable income, it will also help contribute to inflationary pressures. As a result, the market has adjusted its expectations for Federal Reserve policy. Previously, 4 interest rate cuts were priced in for 2025. Now that number has been revised down to just 2, reflecting the potential for rising inflation. Beyond U.S. policy, there are several global factors shaping the investment landscape. Technological innovation continues to drive growth, particularly in sectors like AI, cloud computing, and green energy. However, geopolitical risks remain a top concern, from ongoing trade negotiations with China to tensions in emerging markets. Both of these are factors that will add an additional layer of complexity, making it critical to maintain a well-diversified investment strategy. In the bond market, yields on the long end of the curve have started to edge higher, reflecting inflation concerns and shifting expectations for future rate cuts. Given this environment, we remain focused on sectors and asset classes with strong growth potential. We're overweight in U.S. growth stocks, particularly in the technology sector, which continues to lead in innovation and in performance. On the fixed income side, we're closely monitoring duration, as longer-term bonds may face pressure from rising yields. By staying nimble and focused, we're positioning portfolios to capitalize on opportunities while managing risk effectively. As always, our focus is on helping you achieve your financial goals. If you have any questions about the market, your portfolio, or just how to navigate these changing times, please don't hesitate to reach out. Thank you for your trust in us, and I wish you a wonderful end to the year.